Thank you so much for joining us today for Barry Dunn's quarterly In the Know podcast, a series focused on the financial services industry, current trends, and hot topics. My name is David Stone, and I'm joined by Susan Weber. Susan, welcome. So happy to have you here today and to continue this In the Know conversation.
Well, hi, David. It's great to be here. And in keeping with the holiday, I think we have all sorts of treats for our listeners today, right? Everything from the quarterly banking profile, any sort of accounting updates. The economy certainly has been in the news lately, so we'll chat about that. Maybe we'll dabble in overdraft and junk fees, that whole battle that's continued to rage this year. Climate change and ESG is definitely on the radar, and maybe we can have some time for some fintech news in there too.
Whole sort of fun topics today.
That's it. We have a lot on the agenda. It's action-packed, right? End of year, action-packed. So let's jump right on in. So David, the FDIC recently issued its third quarter banking profile. So any trends there that are worth noting?
Yeah, sure. It was an interesting quarter for sure, which in and of itself seems to be the trend for this year. We had some new quarterly banking profile records set. We also saw the continuance of some trends that we really haven't seen for a couple of years.
Oh, really? Like what?
Well, the big one that comes to mind is net interest margins, which rose for the second straight quarter. And this is great because, for several previous years, they'd been declining.
Oh, yeah.
So for community banks specifically, net interest margins increased 32 basis points from the year ago quarter and 30 basis points from second quarter of this year.
That sounds good.
Yeah, exactly. Definitely a good trend.
That's awesome. Well, what happened with net income, though? And I guess I'm thinking specifically for community banks.
Sure. So community banks saw their quarterly net income increase 13.5% from second quarter 22. And this was primarily driven by that net interest income. So really going hand in hand with that increase seen in net interest margins. However, that 13.5% net income increase was somewhat offset by increases in both non-interest expense and provisions for credit losses, as well as a decrease in non-interest income.
Well, I seem to recall the last time we had a podcast, our last quarter podcast, we were talking about unrealized losses. That was a big hot topic. What are you seeing there? Anything new or different there?
Yeah, so unfortunately, the unrealized loss picture got a little bleaker in quarter three. Unrealized losses on securities, they continue to climb. Increasing almost $21 billion for the quarter to reach $76.1 billion total. This doesn't necessarily have any bearing on net income, but it's certainly a trend that we continue to watch, and we hear clients continuing to talk about with boards and those charged with governance.
So you mentioned earlier that there were some new records that were set in the third quarter. You want to care to elaborate on which ones?
I guess I should, right?
Holding you accountable there, David. I want to know, promises. So what were those records?
So the records I alluded to were the non-current rate and the coverage ratio, which certainly go hand in hand. The non-current rate hit a quarterly banking profile record low in quarter three of 47 basis points. And then on the flip side, the coverage ratio hit an all-time high of 263.4%. And just to provide some reference here, data collection for these rates began 38 years ago, back in 1984.
Well, I can only speak for myself, but in 1984, I was definitely not paying attention to the non-current rate and the coverage ratio.
You and me both, Susan. And we continue to see record low delinquencies too, which is helping drive up that record high coverage ratio. We did see a 1 basis point increase in reportable delinquency to 32 basis points, but for perspective, that remains well below the pre-pandemic 55 basis point average.
So all in all, really okay as we're coming in on the end of the year. What about any accounting standard updates? Is there anything there worth noting?
Yeah, there haven't been any significant accounting standards finalized since we last chatted, but I do recall mentioning one in the works regarding tax equity investments and the accounting for such. And
Mm-hmm.
that accounting standard, it is still in its proposed form. FASB is also still working on additional guidance on common control leases. I think I had mentioned that last time as well. And again, this likely won't be significant to financial institutions, but it very well may be for some of their commercial borrowers. So I think it's definitely worth keeping an eye on it. In the FASB, they did propose or issued a proposed ASU that would provide a practical expedient that would allow private companies and not-for-profits, so not public entities, it's just for private companies and
Mm-hmm.
not-for-profits, to use the written terms and conditions of an arrangement between entities under common control. So keep that in mind. It's only for common control leases.
Okay.
And this is rather than on the basis of legally enforceable terms and conditions. So this proposed ASU, it also makes some targeted changes to the accounting for leasehold improvements within common control leases. So nothing's been finalized, but I thought it was worth noting that these two ASUs are in process, ones we're closely watching, and we'll certainly provide updates and dive into these ASUs a little more once they are finalized.
Well, I think it's always really helpful to know that you are watching and prepared for what's coming at us in the future. One less
That
thing I have to worry about. That's awesome.
yeah, that's my thing, Susan. That's it's kind of sad to see it, being such a quiet quarter on the accounting standard front, which a lot of people probably can't say that. So,
That's awesome.
all right, so the state and direction of the economy continues to be hotly debated. Susan, you want to jump in the ring here? Any thoughts to share?
No, I really don't. No. Honestly, what a gift it would really be if everything just stabilized over the next few weeks, right? I mean, it
Sure
just
would, sure
it
would.
just would. It has been and remains very confusing, I think, for most people. Every month, some indicators, some economic indicators improve while others seem to get worse. But we did get two key updates recently. The first one, the most recent one, the FOMC, or the Federal Open Market Committee, held its mid-December meeting and pretty expectedly raised interest rates again, although this time 50 basis points, not the 75 they've been doing the last several times. I think generally the markets expected that level of increase, but I do think that in general, the state of economy and any move that the Fed makes at this point is just hotly debated. Along with that, there were some changes in some of their forecasting metrics. I guess the two that I would mention is a slight adjustment in projected economic growth, just 0.5% in 2023. And then picking up in 24. And then the median projection for unemployment went to 4.6%, up from 4.4 in September. So definitely anticipating some continued pain and stress next year, although I think the jury's still out on the extensiveness of that.
Sure. Now you mentioned two key updates. I want to gander a guess here on the second one.
Okay.
Is it November Beige Book, possibly?
Ah, ding, ding, ding. That's it. No coal in your stocking, David. Yeah, that's it. Published on the 30th of November. So the opening quote was this, right? And I brought it because I had to read it. It just struck me so funny. Economic activity was about flat or up slightly since the previous report, down from the modest average pace of growth in the prior Beige Book period. I don't know about you, but I read those things and I'm like, so are we good or are we not good? It's clear as mud.
Yeah, a little confusing there.
Yeah, it sure is. But basically, I think what it's saying is growth was about average and now it's less so. right? But the news isn't all bad. So New England is covered by the Boston Fed update, which basically said the same thing. Essentially, despite some pockets of high demand, business activity was generally down and results were mixed. I picture a giant seesaw, right? When my sister and I were little, we'd go back and forth for a while, but then we'd always try to balance it right in the middle. And I think that's generally what is missing right now at the moment, right? Is that balance in the middle. And we're still in that phase.
I love that. That painted a great picture. So thank you for that. And
Sure.
there doesn't seem to be a clear picture ahead, does there?
No, and I think the uncertainty is really troubling to so many people. The Boston Fed update indicated most expect at least some short recession in 2023. I think we see that a little bit in the FOMC forecast update. An article published by the American Bankers Association in November summarized a recent bank rate survey of U.S. adults indicating that more than half have delayed major purchases like homes and cars, and almost 60% have opted out of things that cost money like vacations and entertainment. I was actually surprised by that trend. Up here this summer, you wouldn't have known it, that kind of thing. But I think the recent run on Taylor Swift concert tickets alone probably would debate that as well.
Yeah, so some of those ticket prices were, geez, crazy.
I know, right? I would need a loan for some of them. And that probably nicely leads to one last point I want to mention here, and that is that the annual report released in November by the Financial Stability Board, their report highlighted the risks posed by the buildup of debt outside the financial sector, right? Trends like buy now, pay later, which could ultimately weaken any borrower's ability to repay debt held traditionally by banks, sort of like a domino effect.
So in terms of the economy, sounds like we're still on edge going into 2023. Is that safe to say?
Yes, and on the edge of our seats, I think.
Yeah.
Maybe a bumpy ride ahead, right? Strap in.
Yep.
So there seems to be no shortage of things to worry over. I almost hate to do this at the end of the year, but along those lines, I want to switch gears a little bit and, David, maybe talk about another loaded topic, overdrafts.
Oh boy.
Okay. We seem to have a bit of aggression playing out. That's my word, not anybody else's. But it has been and continues to be really heated between the various associations and the CFPB. And then in November, we had this Twitter exchange, right? This odd Twitter exchange between President Biden, or at least his account, and the American Bankers Association.
That's right. And I happen to have it right here. Let me pull it up. So yeah, mid-November, President Biden's Twitter account stated, and this is a direct quote, "Unfair hidden fees known as junk fees take real money out of the pockets of American families. Things like banking overdraft fees and excessive credit card late fees, they add up. My administration is making it clear that they're illegal." Ooh. And then I have the response from ABA here as well. And this is also a direct quote. "Respectfully, Mr. President, the CFPB sets the allowable amount for credit card late fees, and they are, like overdraft fees, highly regulated and fully disclosed to consumers by law."
Wow. I can certainly appreciate the ABA's comments about regulation and disclosure.
Yeah, we're hearing lots of frustration within the industry, with the perspective being the majority of banks are not only following the regulations set for overdraft fees, but they're also clearly disclosing them. And, there was a wave of larger banks who made headlines, I believe it was last year, by eliminating some of these fees. But the discussion continues, and it certainly creates a lot of anxiety.
Is there any call to action here? Where do we see this sort of playing out?
Yeah, great question. We're hearing this come up in management and conference discussions for sure. And, the ABA, as we just, provided an example of, has been very active and vocal about trying to hold people accountable for misinformation and undue characterization. So, perhaps getting engaged in the discussions and legislative agendas of the state associations is the best first step. That's what I would think.
That's a really great point, David. This really is as much a broader industry issue than a particular bank, issue. No one bank is really under fire here. So
Yeah.
lending your voice and support is an action that every banker can really take.
Yeah. Yeah. Agreed. So Susan, let's jump to the next topic. Just as fun and exciting, ESG, so environmental, social, and governance.
Mm-hmm.
It seems like everywhere I turn, there's more information on this topic. What's the latest buzz, and what does it mean for financial institutions?
Yes, absolutely. And to quickly level set, if folks listening are not familiar with ESG, please do some research. This is a very significant topic that will potentially affect every industry in some way. We have a good overview article on the Barry Dunn website, which we'll make sure to provide a link to in the podcast description. But for today's discussion, I'd highlight maybe a few things: the timeline and who we're watching for setting standard disclosures and what's happening on the financial institution regulatory front. The big focus first anyway is climate change and climate risk. December into January are key months. It's when we're sort of expecting some new climate disclosure standards to be announced from both the international and US-based authorities that are charged with this, so namely the ISSB, or International Sustainability Standards Board, and the SEC, or the US Securities and Exchange Commission.
So large public companies, including banks, operating domestically and abroad, I'm assuming will be impacted?
Yes, that's exactly what we're watching now. And we're particularly watching the ISSB because while their climate standard draft is due in December, members are looking at a whole host of related topics for future changes. For example, a recent agenda paper spoke about biodiversity, including nature-related issues, the way organizations manage their employees, and human rights disclosures. And there's an alphabet soup of organizations lining up to act essentially as working groups to write the detailed rules around the standards that the ISSB sets. So it seems clear that while the standards may start with climate, or the E, environmental, more is going to follow in order to comprehensively cover the S and the G of ESG. And we also expect that while this may affect the bigger companies initially, it will likely filter to mid-sized and small companies, including banks, in the future. In the meantime, we also expect that approved standards would certainly apply to any companies and banks of all sizes who elect to start disclosing the information now, to do it in a uniform way.
Yeah. And since we're on the topic of disclosures, this will likely affect the way audits and assurance work are conducted in the future, I would suspect.
I would suspect so too. Exactly why it's important to stay on top of the developments in this area. The jury's still out. Some people think it's just going to, flash and burn out, and nothing will come of it. I think with anything major like this, you sort of take a step forward and two steps back. So I think that there's momentum here, but that's just my personal opinion. But I think it's important to stay on top of these developments so that it doesn't catch you by surprise. And I guess I'll mention one more, and that is financial institution regulations, right? So while there are no new supervisory regulations to date, I think the momentum is definitely there, or at least the framework is becoming. The OCC earlier this year, right, the Office of the Comptroller of the Currency put climate change on their supervisory agenda, and then created and quickly filled a new position called the Chief Climate Officer. The OCC has been vocal about their need for discussing and including, climate change and overall financial and risk management practices. Some even are thinking about scenario testing. And of course, whenever I think scenario testing for climate risk, I start to think about loss prediction. So I get CECL wrapped up in this in some way, shape, or form. I had to go there. And the FDIC has not yet officially placed climate change on its agenda, but is under some pressure now to do so.
So sounds like we'll have more on this topic to share in our podcast in 2023.
I think we definitely will, David. And as we close out today's discussion, what do you have for us in terms of news and trends in fintech?
Sure. So on the fintech front, the U.S. Department of the Treasury released a report stating that fintech firms are creating new risks to consumer protection and market integrity. And they went on to say that while fintechs can speed up technological innovation and advancement, they pose increased risks because they are not subject to the same rules and oversight related to, for example, data privacy.
So some really great technology, but maybe playing it a little loose with protecting consumer information.
Yeah, exactly. So the Treasury is strongly recommending the regulatory agencies create a new supervisory framework for these bank and fintech relationships, really making it clear that they're subject to the same consumer protection laws and how they expect to supervise this going forward.
So more supervisory oversight may be coming for fintechs, at least when banks are involved, is what I'm hearing. And it'll be interesting to see what the regulators do next and what effect it may have on these relationships in the future.
Absolutely. I think there's a lot to learn from fintechs. They're largely known as being agile organizations that have led the charge, in alternative payment structures such as buy now, pay later, and in the P2P payment services.
Mm-hmm.
Those are just two examples of technologies traditional banks are taking notice of. But I think the lesson here is that any partnership with a fintech or even the adoption of technologies that are traditionally associated with a fintech need to be done mindfully, with the regulatory landscape really front of mind.
Well, it's a good reminder, I think, to leverage the best of what you both bring to the relationship, right? The agility and innovation balanced, I'm back to that seesaw again, right? Balanced with consumer protection and risk management best practices.
Absolutely. Well, thank you so much, Susan. And thank you to our listeners for tuning in. We've covered a lot of content today. And, so certainly if there's any questions, please, don't hesitate to reach out to Susan or I directly. Or reach out via our Ask the Advisor feature on our website. Happy holidays, happy new year, from the Very Dunn family to yours. We really do wish you all the best and hope you'll tune in to our next In the Know podcast.